You may have noticed as all the equity markets and many other markets were tumbling, oil markets were actually going higher. And here to talk to us about that today is Dan Dicker. Dan, it's always great to have you.
Thanks, Joe.
Let's jump right into it. What's going on? Why are oil markets
I think this is the most important story that I could bring to people at the street. It's that, we have an asset class, or all the asset classes. Normally, you could have some diversifiers where you'd have an asset class doing better as opposed to another one. But since the FOMC meeting, everything has gone south, virtually everything, including gold, which has been your standard storehouse of value when paper assets like stocks and bonds particularly have a tough time and have a tough go. And gold, it may be the worst out of everything. I mean, it's trading 1275. It looks really bad. I wouldn't be a buyer of it here, despite the fact that it's normally the diversifier that we use. And what's happened is that oil, and to a certain degree, has replaced gold as a diversifier. And you saw it yesterday, where the stock market was down 160 some odd points, and oil was actually up $1.40. Now, this has been the case for the last several days. Even when it gets hit, as other asset classes have, it has gotten hit a whole lot less. We've got Brent prices still above 100, $95 WTI prices. I mean, you're looking at something where oil may be the last bastion of a diversifier, a little bit of a storehouse of value that investors can look for as we move through some very, looks like very rocky times over the next several months.
So what is the value that these investors see in it?
Okay, so there's two things that oil does that nothing else can do. And one of it is it's financialized in the way that gold is.
Sure.
In other words, there's ETFs, there are hedge funds, there's physical funds you can buy, there's everything connected to the GSCI, the Goldman Sachs Commodity Index. So they're index-based funds, and all of these things for the most part are tied almost exclusively into oil, okay? So in general, you have institutions, you have money managers, and you have retail players who can access the price of oil in the way that they can access gold, in the way that they can access stocks and bonds. So it's an alternative. It's a thing that they can use in terms of very big money motion. You can take a lot of money, move it out of bonds, and move it directly into oil, and it won't upset the cart. It won't upset the horse and the cart as it will in some other areas, in some other asset classes. So it's financialized. That's very important. The second thing, of course, is that oil is actually useful. You can burn it. You need it for energy. In some ways, it's the most of the staples. It's the most clear staple type commodities that are out there. Of course, we need copper. We need grains. People have to eat. But in the end, oil is something that you just cannot whatever do without, to obviously to heat your home, to power your car, to make sure that business has energies to work. All of these things, oil is the most fungible and in some ways the most staple of all the commodities. And that's what makes oil very special, and why I think money managers have flocked to oil when the gold trade has looked pretty tired right here. And we see that the Commitment of Traders reports has shown that the number of spec positions in the crude oil market are at 3-year highs. So it's nothing, this is something that's been going on for a while. You saw it leading up to the FOMC meeting, but it's not too late now. It looks like oil is really the strong one here in a market that looks like it's going to be weak for a while.
Sure. So everything you're talking about here, Dan, suggests that a lot of traders, maybe not necessarily investors, see support in the oil market. They certainly have not seen it in the gold market. So when the retail investors are trying to figure out what that support is, what are some of the support examples you could give?
Right. And I think, it's kind of hard for people to understand, but I want people to not necessarily get into the oil futures market directly.
Sure.
But try to find stocks that will monetize a high price for oil. Yeah. And that means that I think that the time is very ripe to be in oil stocks as a diversifier for the rest of your bond and stock portfolio, maybe now more than ever. And I would think that the ones that are less bond-like, the ones that are less sensitive to interest rate fluctuations, which we're going to get quite a few of, therefore a little less of the Exxon and Chevron type play and a little more of the growth type or the beta type E&P play. And I'd say something like Anadarko, Apache, Noble. All of these are going to be, I think, a great diversifier right now for a market that looks like it's going to have a little bit of a rocky time through the rest of the summer.
All right, great, Dan. Well, we're going to have to keep an eye on it.
Right.
You heard Dan keep an eye on this oil market. It is the one market that he has a lot of faith in. It's not just him, it's traders and investors who are looking to get into some of the oil stocks. For The Street, I'm Joe Deaux.